So the five stocks we're looking at right now, Apple, Microsoft, Alphabet, Amazon, Meta, none of them existed the last time that this happened. If you really think this is a stagflation environment, none of them were there in the 70s. How do they react to an environment like that?
Well, the great thing is, if you go back to what I said, it's a show me the money story. So the good news is every single one of those stocks you mentioned to different degrees makes a lot of money. They are very profitable. They have reasonable PEs, some more than others, obviously, like Google, which is our favorite out of the big cap tech names. If you look at Google, they're growing revenues, high teens this year. They benefit from the economy's opening up because don't forget, they get a lot of advertising, 10 to 15% of revenues from things like hotels, airlines, vacation spots. I didn't go on vacation this last holiday season, but I'm sure planning on going on vacation come this next holiday season. And so they should really benefit from those trends. That's why that's our favorite name out of the big cap tech names. The rest of them, obviously, like Amazon's is already been giving back. They've missed several quarters on e-commerce. That's going to continue to slow. You got to worry about, whether there's some give back in smartphone demand or PCs, which we haven't seen yet. So, and obviously we've seen the issues with Facebook related to Apple. So each one's a little bit different, but I think they'll hang in better than the rest.
If this is a situation where the Fed doesn't react as quickly because of the uncertainty on the global scale at this point, and geopolitically, does that mean too much pain has already been baked into a lot of these stocks that have taken hits?
I unfortunately don't think so, because if you step back and look at the big picture, you've got inflation running at 40-year highs, but you've also got valuation sitting at near record levels. And by that, I mean, if you take the market cap of the stock market divided by the GDP of the US, you're sitting at about 1.8 times. The peak of the tech bubble was 1.4. The average over the last 50 years is 0.8. And during high inflationary periods, you usually have lower than normal market multiples. So unfortunately, you still have a lot of pain that can be inflicted just by multiples compressing. And don't forget, growth is going to slow down this year. The Russia situation just adds to it. They're only 2% of GDP, but they export 30% of the world's wheat. They put out a lot of the neon gases used in the semiconductor industry, palladium, nickel. They're top producers of that as well. So it's going to affect a lot of the input costs going into the tech industry, as well as others like ag and industrial. That's going to be a big problem for inflation, and that's really the issue. And high inflation means low multiples and slowing growth. That's unfortunately the soup you're in right now, which isn't good.
Shepard Smith here. Thanks for watching CNBC on YouTube.